Hey everyone, I'm excited to talk about Avondale Commons. This is our latest project in Phoenix, Arizona, and I'm joined with my Vice President of Investor Relations, Chris Perinello. My name is Vikram Raya. I'm CEO and co-founder of Viking Capital, and this deal is really, really interesting, and it just got sweeter. Chris, normally when you're in the middle of a deal process, you get the terms, you get negotiations, and you're good to go, and then you present the deal to investors and we move forward on the process. This deal is a little bit different. Avondale Commons, the 324 unit deal, Class A property, just finished being built. We're getting at a severe discount already. Now we made the deal even better. How did that happen and why did it happen?
Yeah, I think as we've launched this deal, as I've been talking about it with investors, one thing that I've mentioned to a lot of you, the ones that I've had conversations with, is Viking never stops negotiating on your behalf. So we're constantly trying to reduce risk and make every deal better as we continue conversations with the lender. And deals tend to change a little bit over the course of getting them under control. And this deal is no different. So when we originally kind of took this to committee and then worked through the relationship through the developer with the original equity, we found a deal that we felt was within market, really was trying to find something where it was a win-win for everyone. As things changed, the time of capital needed changed, the amount of capital needed at certain milestones changed. It opened up a leverage point that Viking needed to take advantage of for the investors' behalf. And now the deal has gotten significantly stronger, especially from a risk standpoint. And we're super excited to tell you all about it.
Yeah, and with that said, guys, I want to present you the slides we have on the updates to Avondale Commons. As we mentioned, this deal just got 50% sweeter. And the reason why is we originally were able to almost guarantee our investors a 10% IRR because we were able to negotiate. But after further negotiations and timing of the market and where this deal is sitting in terms of the market cycles and real estate cycles, Chris, what were we able to negotiate now?
The most incredible part of this new structure is that where we had originally created a floor of a 10% IRR, not average annual return, but a true IRR, now our floor is a 16% IRR. This is really important because one of the beauties of this deal was that it was being structured in the form of what's called a hope note. And we believe in this deal or we wouldn't be doing it, but we wanted to reduce our risk and the investor capital's risk. And the easiest way to reduce risk on this deal was to put the majority of our return ahead of the principal repayment of the original 30 plus million of equity. And we were able to accomplish that. We'll dive into exactly what that means on subsequent slides.
For a refresher for many of you, this is Avondale Commons. This is the multifamily property we got under contract about 30 to 45 days ago. And it's a 324 unit Class A property that's just recently got built this year in 2025. So built by a very established developer, Overland Group, which we know very well. And this is on average 935 square feet per unit. There are even townhomes as well, overall 4-story construction, structured parking spaces as well, covered parking. Again, a beautiful, beautiful property. And essentially we're getting a Class A property, but we're able to provide value add returns, which is essentially very difficult to do. Here's some of the information on total capitalization. This is $122 million in terms of build cost. The debt is $67 million. The total equity in the deal is $55 million. And the interest rate 7.5%. This will probably be a 5-year hold. There may be an opportunity at the 3-year mark to reevaluate. Total Viking equity that we're bringing into the deal is $25 million, of which $19 million will be Class B and $6 million will be reserve class. As a reminder, Phoenix is really thriving in terms of employment. Outside of these main employers, there's a huge move for basically the chip manufacturers, TSMC, Taiwanese Semiconductor, Intel Corporation, Amkor, all these big chip manufacturers are increasing their fabrication plants. They're hiring tons and tons of workers. And it's the multiplier effect is having huge repercussions in a good way on the economy. And on top of that, it's a healthcare hub. Mayo, Arizona is here, Mayo Clinic. Banner Health employs 55,000 people, one of the hugest employers. St. Joseph's Hospital, 5,000. In fact, there's Children's Hospital right across the street from Avondale Commons. You can throw a football from the parking lot of Avondale Commons into the parking lot of the Children's Hospital. Amazon has a huge presence here. Honeywell, one of the automation companies, American Express. So we like buying properties in areas where there's positive net migration, there's strong employment, and a diverse employment base. What this means is it provides safety for our investments because we know there's a robust tenant base. Really, the story here, Chris, I would say is the basis what we're buying it at. A lot of people are like saying, man, if you can buy these deals at this cost basis, when the economy turns, when interest rates drop, when cap rates compress, even if you do nothing besides just owning the property, you're going to make a robust return. And so that is really one of our investment thesis here. This all-in brand new build price with the construction costs, this was almost $380,000 to build new. We're acquiring this at $286,000 per door. There are existing B-class properties in Phoenix at that same cost per door.
Yeah, and I think this is a great opportunity to kind of explain what this opportunity really is. Because really, we're not just acquiring this property, we're really coming in and we're recapitalizing it. In many cases, opportunity comes in the form of distress for somebody else. I think this deal is no different. The timing of when it was developed and into what market it is going to enter into as far as supply and demand economics is one of the stories here. So our cost basis, your cost basis as an investor in this deal is much lower than the cost of construction. We're going and putting this 25 million of equity in, and we're sitting directly behind the senior lender. And that is why this is so powerful with the floor that we were able to negotiate, because at a 16% IRR and all of our principal and returns coming directly behind the senior lender, our basis, including our return, or at least the floor of our return, is protected with the insulation of original 30 million of equity.
And so the way to think about it is a sponsor and a builder brought this project, took it to market, raised the capital, built it, and over 3 years, based on tariffs, timing, taxes, labor, slowdown, for whatever reason, they're coming into a place where they can't achieve their exit price. And now they're having a challenge. We're able to take advantage of the challenge, obviously still provide some value to them. Otherwise, they would just exit it and take a loss. But we're able to now say, hey, look, we can now take advantage of this, buying it at a steep discount, a 21% discount, $30 million off. And now we control the deal. We'll run it, our typical acquisitions. And on exit, we're guaranteed X amount, the 16% for our investors IRR. And then after that, there's a chance for them to obviously recoup some of their capital, and obviously for us to even get an enhanced return. And so that's what we're going to present to you now.
The only thing that I'd add on top of that is the GP team is really getting strengthened, I think, by Viking coming in and bringing in this additional capital. The original sponsor and the developer really, they executed well. They built a fantastic property. I've been to it 3 or 4 times at this point. It's beautiful in a beautiful area of Avondale, which is very robust. And the only main adversity, really the only adversity that this property is facing, is headwinds that they thought were going to be gone at this point. So the timing of this deal, when it was started, when it was completed, and now what it needs in order to get through kind of a lengthy stabilization period, is the support that it needs. And it's a huge opportunity for Viking, but there's also a lot of opportunity for the original investors in the deal as well.
If this property was built in isolation, it'd still be a phenomenal deal. But the cool thing is it's built as part of a master plan community. So there's mixed use around it. There's a hotel development happening, 100 to 120 rooms. There's retail with confirmed leases of Starbucks, which is huge. Again, just the demographics of that and the demographic study that they do before they put a new office or a new location is very robust. So they really believe in the growth story of Avondale in Arizona, in the Phoenix area. Obviously, medical office, it would make sense because it's right across the street from the hospital system. So complementary medical office to support the doctors and the patients. makes this a really ideal place. So a lot of our tenants would take advantage of these services. A lot of our tenants could probably be from some of these services as well. So really why we love this deal is it's off market, right? We're able to negotiate this and secure this because of our relationships with a lot of the other major sellers in the country. If this was broadly marketed, it would have been a bidding war typically. That's usually what happens in Phoenix. Number two, as Chris mentioned, the low entry basis that we're able to acquire our equity position is below construction cost. And anyone in multifamily will tell you if you can buy below construction cost, that's really a great deal. And what happens is, obviously, off offense, people will do very well, but we're also looking at defense, how there's such a strong margin of safety because of the floor we're able to negotiate. Number three, there's a path to progress. And I've mentioned already the employers here. I mentioned the growth. There's so many tailwinds, the AI tech firms, the healthcare giants. All of this is boding well for a robust tenant base, rent growth, and probably supply and demand mismatch going in favor of landlords and multifamily owners. And then number four is really the high demand and limited supply. This is really further exacerbated by supply has really fallen off a cliff after 2025 due to tariffs, due to taxes, due to just rent patterns. There's not a significant amount of supply going online. And number two, absorption has been really robust. So whatever supply there was has been absorbed. So that leaves really the ability to lease this property up quickly and to institute the business plan to slowly lease it to market. We already own a project or will own a project very shortly in Peoria, which is maybe 5-10 minutes away. And we're going to have economies of scale. We'll be able to have sharing of supply, sharing of construction, sharing of resources in terms of teams. Pegasus management systems will be managing both apartments. And so a lot of that will allow us to save cost. And the final thing is, as renters decide where they want to live, a lot of them are choosing a flight to quality. People who are choosing to rent by choice instead of because they have to, because they're preferring not to deal with the maintenance of a home. Again, home ownership is becoming exceedingly unaffordable. People are choosing to live in luxury accommodations such as this. And so for all those reasons, the flight to quality story still resonates.
Yeah, and keep in mind that a lot of these same economic drivers and key fundamentals of why this deal was amazing when they decided to build it 2.5 years ago haven't changed. And the headwinds that have been faced were really created because of how attractive this deal was several years ago. Like, I understand why they were able to raise $30 million for this deal when they were developing it, because it was obvious that this area was going to explode. And when you go to where we have our development site, Peoria, and you go to Avondale, it feels more obvious that Avondale is the place that has already achieved its place in the path of progress. Now, I think that might have been one of the potential red flags, is you had so much development there, you had so much supply coming online, like Bikram mentioned, a lot of that's been absorbed. What this still needs is time. It needs time to navigate from the headwinds to the tailwinds, but those key fundamentals were and still are there. When you look at our Peoria deal, a little bit less obvious. Like, we're developing there because we believe in the story of Peoria, and we think that it's going to see the same growth that Avondale had 3 or 4 years ago. Now, what's amazing about this deal is we're structuring it in a way with very, very low risk and a 5-year time horizon to navigate it to where we're actually going to be able to get this stabilized and sell it at a 4.5% to a 5% cap rate, which on future slides we'll kind of go through what sales prices we need to reach in order to kind of hit the returns that we're hoping to get.
And this deal has just gotten even better, as we talked about. And the way it's gotten better is, one, we've been able to negotiate that higher preferred return to our investors. So essentially a 16% to the deal, at least a 15% IRR to our investors is built into the structure. This provides risk mitigation and investor confidence. Number two, there's safety in the capital stack. We are placed essentially, besides the bank, who has to be paid, obviously, we're the next group to be paid, which means we're at the highest part of the capital stack. And this reduces our downside risk. Number three, bigger tax advantages. So obviously we already able to have some bonus depreciation. We have the capability to potentially get potentially twice as much. And we're in the final stages of trying to figure out what that looks like with our tax advisors. And number four is there's more cash in your pocket by potentially reducing taxes and negotiating this higher effective return that gives our investors truly a leg up on their wealth creation. And the final thing is we at Viking really need control because we want to really protect our investors. And so by us having that investor control of this project, it really allows us to have that governance needed to make sure we take care of our investors at every stage. And so I'm going to let Chris walk us through the original capital stack and then how, after the renegotiations, how this has become even better for Viking.
Yeah, and I worked with the marketing team for hours to try to figure out how to really explain this well. And I think we found a way that was really well thought out. So when you look at the column all the way to the left, that was the original capital stack. So you had a $79 million loan, you had $4.5 million of preferred equity, and you had $30.25 million of existing equity. Now, the original deal that we structured was replacing the debt and the preferred equity with a new loan for $67.2 million. The Viking equity golden tranche of $32.22 million includes what it would take for Viking to achieve a 10% IRR. And then you have the existing equity. So the way that I want you all to think about this is this development cost, I think it was around somewhere between 114 and 118 million dollars to construct. That was the cost of construction. We know that today, given the higher value of the land and the higher cost of construction, that it would cost even more to construct than it cost them over the last few years. What we've built in, so if you take the debt number and you take the Viking equity number, that comes to $99.4 million. That is our basis plus a 10% IRR. So with the original structure, if we sold the property for just cost of construction, we would be coming out ahead. We're also in this original structure, and this is, call it a downside, but we talk about like risk versus reward. In the original structure, we had a floor of a 10% IRR. However, if this project did exceedingly well, after we paid back the $30.25 million of existing investor equity in the deal, we would get 75% of the additional profits. Really solid deal. If you notice, we had this modeled out to almost an 18% IRR, which is higher than our new floor. Now, moving over to the new structure that we were able to work through with the developer and the original equity is the same lender. Now, the difference is we've essentially negotiated an additional $12.4 million in a higher piece of the equity waterfall. So now if we sell this property, we would have to sell it for, call it $112 million, which is still under the cost of construction. But now Viking investors are getting a 16% IRR. And they're getting that 16% IRR before the existing equity gets $1 of their principal back. Hard to engineer this deal. It's hard to compete with this deal from a risk standpoint because you know that the property's already completed. So the execution risk on developing it from another development, which would be the only way to get the same basis as if you were building something from dirt up, but no entitlement risk, no development risk. The one risk that remains is stabilization. But we built contingency around that. So we built a plan to stabilize this over 20 months. To give you perspective, the Peoria property that doesn't compete with all of the supply that's in the region is set to stabilize in 12 to 14 months after construction is complete. So we added almost an additional 2/3 of a year to get this property up to stabilization to reduce the chances of selling this property below $112 million, which I think if I'm looking at this, if we can get this stabilized over 20 months, this thing should be selling at $130 million, $140 million. Now, what you lose, because anytime you renegotiate something, it has to make sense for all parties. And when you land on a compromise and it's a good deal and it truly is a win-win, we still needed to keep in frame the objective of the original sponsor, which is to get the Hope Note back. So after we get our 16% IRR, they're still going to get all of their equity back. We would have to sell the property for $135 or $140 million in order for them to get their equity back, which is what we modeled out. So the real shift here is increasing the chances that we get a 16% IRR in a normal or downside scenario. And really, it's coming at the expense of safety for the original equity. Now, unfortunately, the original equity that's in this deal was always the group that needed the white knight to come in. So it made sense for us to give up the 75-25 on the back end and make it 50-50. If this thing goes according to plan, and if we can continue to execute on it the right way, all of the original equity will be saved. This is more in line with a true hope note, where we're bringing in this really strong tranche of equity, and our equity feels really comfortable that even if things don't go according to plan, if we stabilize in 22 months instead of 20 months, or we sell this thing at a 5 cap or a 5.5 cap, we're still getting a 16% RRR, and you're still getting really strong risk mitigation in this deal. And the way we've modeled this out is over a 5-year hold, and our downside scenario, investors are getting right about a 2x return. The only way that you're not getting that 2x return, I think this is really important, is that this $30.25 million is completely gone. And we're selling for at construction or lower than construction. So this is just another way to kind of review it, which is the lender, who's in first position as the largest investor in this deal, Viking's equity being returned, the 16% IRR. This is the amount of profits that it will take to service a 16% IRR over a 5-year hold, the original equity, and then this is the additional, according to our model, we would get another $2 million or so in profits to split amongst our equity in the deal.
Really what's happening is we're taking the back end profit that was going to happen at the very end, and we're shifting it up about 3 notches. And what that means is, for investors in the Viking platform, this is safer, stronger, better. And as an investor, this is reassuring to me in terms of how I'd like to invest, especially with a lot of the challenges and the volatility we've seen over the last few years.
And that's exactly what I was going to touch on. I think it's not lost on any of us, whether you're an LP or whether you're a sponsor. Business plans that have been put into place in this specific asset class, and a lot of the key fundamentals that are really strong, have faced headwinds. And this kind of takes the risk of the headwinds lingering around before we can get to a market with true tailwinds. And it still has opportunity. If interest rates come down and transaction volume increases, institutions come back to play, this is an asset that they would really like. And if it overproduces, great, we get this extra $4 million. But if that doesn't happen and the business plan falls flat, we're protected, and we're protected by a tune of $30 million of existing equity before we lose even 1 percentage point of our IRR. Truly, truly a safe deal. This is really just another way of explaining the last several slides. You have for folks that maybe don't spend their time evaluating these types of deals, the cost basis of $92.95 million is simply the loan amount plus the amount of equity we're bringing to the deal. That's not the basis of the deal, that's Viking Capital's basis. The sales price of $111,900,000 is the sales price that we would need to achieve in order to achieve our basis, plus the $18.9 million needed to create a 16% IRR. Now, this is $3 to $6 million lower than the price of construction. So it really would take quite a bit of adversity in order to run into that outcome.
So just to emphasize for those listening to this quick pop-up webinar, it's 111 million is what we plan to sell it for, but that's way below the actual construction cost. The chance of that happening is quite high, especially where we're going with rates actually dropping over the next couple of months to years versus increasing, and more of a bullish real estate cycle. But that being said, this downside scenario is quite lucrative and is quite realistic without anything having to go in Viking's way in terms of like major changes in the current economic situation. And ideally, this should sell for in the 130s to 140s, because that's usually the cap rate and what we've seen historically in this market for this level of an asset, and almost a class A core asset in an affluent luxury suburb.
Correct. We'll go through, and for everyone that wants to really kind of dive into these numbers, which I think most of our investor base at this point does, Judah and I are going to be doing an additional performer review that kind of goes through this to show you what that $111 million would be on a cap rate. But it's like north of a 5.5 cap for a brand new asset. It's virtually unheard of. So that 111 million isn't what we think we'll sell for. It's just the price that we would need to have over $35 million of lost value in order for our IRR to get accepted. So this is something that I want to clearly explain, the bonus depreciation. So I want to give you an idea of where we're at on this and kind of a timetable for when we're going to have a more definitive answer. So bonus depreciation on this asset. Vic alluded to this earlier in the presentation. We've achieved our negotiation. So at this point, the developer and the sponsor are willing to give us the entirety of the $18.6 million of accelerated depreciation that is created from our cost seg. Now, why I can't give a definitive answer on how much depreciation is going to be available is as our attorneys kind of duke it out on what is allowable and not allowable according to the IRS, is simply taking properties depreciation and allocating it to another subset of equity is a disallowed transaction by the IRS. So we're not allowed to just absorb all of it. Now, that being said, there are strategies that we can employ to shift which equity was used for certain parts of construction, certain parts of the property, because certain parts of this building either have zero depreciation allocated to it or have lots of depreciation allocated to it. So just like we're talking about with the floor or the minimum return with the 16% IRR, that the minimum depreciation is the 35% that we originally went out with. We wanted to be very conservative about that. Now, as we kind of push through this, we can guarantee you that it's going to be higher than the 35% that we originally promoted. One realization by both councils is the land value. You can't depreciate the land value anyway. So having the original equity taking on the burden of that land value means that the value of that land, that equity depreciation can be pushed to our side of the equation. So we're employing everything that we can to increase this number. As Vikram mentioned, it could be as high as 65, 70%. It could be as low as 40 to 50%. And as soon as we have clarity, my team will let you know exactly what that is.
So bottom line is, again, everything about this deal is getting better. The bonus depreciation, the IRR, potentially the hold period, how fast we can even lease up. Now that we're recording this in September of 2025, there's a chance that there's maybe a rate cut. That would already increase the value of this asset. So all these things are starting to happen in concert, and we're bringing all these updates to you guys. We're excited about this project. We're excited about this deal. Again, we thank you for your loyalty and your investments with us and the trust. It's not looked upon lightly. Me and Chris really care about our investors and our investor base, and I think you're going to be very pleased with this project. And with that said, guys, I'm excited for you guys to invest in this project. Here's a QR code. Please scan it. You can email us at invest@vikingcapitalllc.com. I know many of you have already expressed interest in this project. Chris, Hayden, Amber, and the rest of the team will be reaching out if you've already booked a call. If not, you can easily book a call here. And Chris, any last words?
I understand this is a unique structure. I think we have really moved mountains in making this the safest deal that Viking's ever done, probably. And reach out to my team. We're also going to be reaching out to you. We're going to want to understand what your thoughts are, any feedback. This QR code will take you to a book a call link with my team. And for those of you that reach out to me directly, reach out to me directly. I'd love to chat through this one with you.
All right. Thank you, guys. See you soon.